Every time an Amazon package lands on your doorstep, every time a FedEx truck rolls past, every time Walmart restocks a shelf, there is a warehouse somewhere behind that transaction. And odds are that warehouse belongs to today's company.
We're talking about Prologis, ticker PLD on the New York Stock Exchange, the undisputed global king of industrial real estate with close to 1 billion square feet of logistics space spread across 19 countries.
1 billion square feet. That's roughly the size of 17,000 football fields. These are not small buildings. And the tenants paying rent on those buildings include Amazon, FedEx, UPS, Walmart, and DHL. Basically, the entire supply chain of the modern economy.
Prologis just reported Q1 2026 earnings on April 16th. GAAP EPS came in at $1.05 against an estimate of 86 cents, a significant beat on the surface. Revenue hit $2.125 billion, just edging past estimates of $2.11 billion.
So on today's episode of Charged Alpha, we are breaking down Prologis, the business, the numbers, the bull case, the bear case, everything you need to understand this company. Let's go. Prologis traces its roots back to 1983, but the company we know today was really born in 2011 when AMB Property Corporation merged with the original Prologis in what was then the largest REIT merger in history. That combination created a logistics powerhouse with scale no competitor could match.
And scale is everything in industrial real estate. Prologis owns or has investments in roughly 984 million square feet of logistics space, concentrated in what they call high-barrier, high-growth markets. Think Los Angeles, New Jersey, Chicago, London, Tokyo, the gateway cities where land is scarce and zoning for new warehouses is nearly impossible.
The business model is elegantly simple. Companies like Amazon need enormous fulfillment centers close to major population centers. Land near those population centers is in short supply. Prologis owns the land and the buildings and collects rent. Amazon alone represents roughly 26% of their annual revenues.
The company is structured as a real estate investment trust, a REIT, which has important implications for how we evaluate its financials. REITs are required to distribute at least 90% of taxable income to shareholders, which limits retained earnings but creates consistent dividend income. And because depreciation is such a large non-cash charge for real estate companies, GAAP net income understates true cash generation.
That's why REIT analysts live and breathe FFO, funds from operations. Think of FFO as net income plus depreciation and amortization minus gains from property sales. For Prologis, core FFO per share is the number that actually tells you how the business is performing.
The company currently has two major revenue streams: rental income from its operating portfolio and development revenue and gains from building and selling properties. The operating portfolio is the steady engine. Development gains can swing quarter to quarter, which is why the GAAP numbers sometimes look lumpy.
Leading Prologis is Dan Leder, full name Daniel Stephen Leder, who became president and CEO in 2023. And here's what's interesting. Dan Leder is not an outsider brought in to shake things up. He's a 20-year Prologis veteran who worked his way up through acquisitions, development, and capital deployment.
That institutional depth matters in real estate. Leder ran North America operations for years before taking the top job. He understands every major market, every tenant relationship, and every balance sheet lever. Analysts generally view him as disciplined and execution-focused, rather than visionary.
He inherited the company at an interesting moment. Just as the post-pandemic industrial vacancy euphoria was fading and occupancy rates were normalizing from record highs. His job has been to manage that normalization without panic selling assets or overreacting on development. So far, the early read is steady hand.
All right, let's get into the numbers. And before I do, let me repeat what Hudson mentioned. For a REIT like Prologis, GAAP earnings per share is not the primary metric. Core FFO per share is. Keep that in mind as I walk through this.
Noted. Let's start with the valuation. Where does Prologis trade?
At roughly $145 per share, Prologis carries a market cap of about $135.3 billion, making it one of the largest REITs on the planet. On a GAAP PE basis, it trades at 36.4 times trailing earnings, elevated. But on a price-to-core FFO basis, you're looking at roughly 25 times, which is more in line with a high-quality REIT at a modest premium to the sector.
What about revenue?
Trailing 12 months total revenues came in at $8.95 billion, up about 7.4% year over year. Q1 2026 GAAP revenues were $2.3 billion. Now here's an important nuance. The GAAP revenue number includes gains from property sales, which can distort the underlying trend. The comparable core revenues that management tracks were $2.125 billion for Q1, essentially flat year over year. That's the steadier signal.
What does the profitability picture look like?
On a trailing basis, gross margin is 43.4%, operating margin 38.9%, and net margin 41.5%. Return on equity is 6.4%, which looks modest, but for a capital-intensive REIT with $57 billion in equity, that's actually reasonable. The more important profitability metric is EBITDA margin, which runs near 86% on a trailing basis. That's industrial real estate working as designed, low operating costs, high cash conversion.
Cash flow?
Operating cash flow on a trailing 12-month basis is approximately $5 billion, giving core FFO per share of around $5.38. Management guided full-year 2026 core FFO in the range of $5.70 to $5.80 per share, which would represent about 6 to 8% growth. That's solid for a company this size.
Balance sheet. The big number is that $35 billion in debt.
Correct, and it's the biggest risk flag on this report. Total long-term debt of $35 billion against $98.7 billion in total assets. Net debt is $33.9 billion. Now, for a REIT with long-duration rent-producing assets, leverage of this magnitude is industry standard. Prologis's debt to EBITDA is around 4.7 times, which is within the normal range for large industrial REITs.
But you're watching it.
Absolutely. With $254 million in quarterly interest expense and a rising rate environment, any refinancing at higher rates hits the FFO directly. And because REIT valuations invert with interest rates, a meaningful move in the 10-year Treasury can compress the stock's multiple, even if operations are fine.
Dividends?
Prologis pays $4.10 per share annually, a 2.83% yield at current prices. The payout ratio on an FFO basis is roughly 76%. Well covered. They've grown the dividend 12 consecutive years. If you are an income investor, this is one of the more dependable checks in the industrial REIT space. Overall, Prologis's financial health is solid. The operating portfolio is performing, core FFO is on track with guidance, and the balance sheet is manageable given the asset base. The main watch points are interest rate sensitivity and the normalization of industrial vacancy from pandemic-era highs.
What does Wall Street make of all this?
The analyst community is broadly bullish. Of the 22 analysts covering Prologis, 15 rated a buy or equivalent, 6 are at hold, and 1 is negative. The consensus price target is around $162, implying about 11.6% upside from current levels. The range runs from a low of $128 to a high of $198.
That's a pretty wide range.
Real estate always has dispersion because valuation depends so much on cap rate assumptions, which in turn depend on interest rate forecasts. The bull case rests on rates coming down and industrial demand remaining firm. The bear case assumes rates stay elevated and vacancy creep continues.
What did analysts say post-earnings?
After Q1, BTIG and UBS both maintained buy ratings. Evercore ISI held it in line. Earlier in the year, Scotiabank upgraded to sector outperform in January, citing the nearshoring tailwind. Baird went the other direction, downgrading to neutral on occupancy concerns, though they maintained outperform through most of 2025. B of A Securities upgraded to buy back in September after a long stretch at neutral.
Mixed signals. That said, 15 out of 22 is a pretty solid buy consensus. Let me make the bull case. You want to own Prologis because you are buying irreplaceable infrastructure at the exact moment the world needs more of it. E-commerce is not done growing. Every incremental percentage point of retail that shifts online requires roughly 3 times as much warehouse space as traditional brick-and-mortar retail. Amazon is not building fewer fulfillment centers. They are building more. And then there's the nearshoring story. Tariffs are forcing companies to rethink global supply chains and bring more manufacturing and distribution back to the United States and Mexico. Those operations need warehouses. Prologis has the land, the buildings, and the relationships to capture that demand. Add in management guiding 3.5 to 4.5% same-store NOI growth for 2026, a 12-year dividend growth streak, $3 billion in development projects at 6 to 7% stabilized yields, and a stock that is still 30% below its 2022 peak. The setup is compelling for a long-duration investor.
Now, here's the bear case, and it's real. Industrial vacancy rates are not at the record lows of 2021 and 2022 anymore. New supply has been delivered in Sunbelt and secondary markets, and some markets are seeing occupancy drift down toward 94 to 95%. When you run a 980 million square foot portfolio, a 1 or 2 point decline in occupancy is hundreds of millions of dollars in lost revenue annually. The balance sheet is also a legitimate concern. $30 billion in debt is a lot of refinancing risk in a world where the 10-year Treasury could stay elevated. And the premium valuation, 36 times GAAP earnings, 25 times core FFO, offers limited cushion if the industrial market softens more than expected. Tariffs are also a double-edged sword. Yes, nearshoring creates domestic warehouse demand. But those same tariffs could slow global trade volumes, particularly at West Coast ports, where Prologis has significant exposure. A trade war that shrinks import volumes hits the Inland Empire and the Port of Long Beach markets disproportionately.
How does Prologis compare to its peers?
Let's use price to sales as the comparison metric, since it works across REIT types. Prologis trades at 15.1 times trailing sales. EastGroup Properties, the most comparable pure-play industrial REIT, trades at roughly 15.3 times. Very similar, though EastGroup is a fraction of the size at $10.7 billion in market cap. EastGroup's revenue growth is running about 7%, essentially in line with Prologis.
What about outside the industrial niche?
Digital Realty, the data center REIT, trades at about 12.7 times sales and is growing revenues around 12% year over year. AI demand is pushing data center REITs to a different trajectory. American Tower, the cell tower infrastructure REIT, is at roughly 8.2 times sales, with slower revenue growth around 3.5%, but it's a much more defensive, contract-driven business.
So Prologis is priced comparably to EastGroup, but at global scale, and it's cheaper than data centers, more expensive than towers.
Exactly. The valuation premium is warranted by scale, brand, and market position. Whether you're getting enough of a discount to current fair value, that's the debate.
What's the options market telling us?
Post-earnings options activity showed a mild bullish tilt. The put-to-call ratio came in around 0.82, meaning slightly more call activity than put activity. Implied volatility percentile is sitting at 62, elevated from pre-earnings but normalizing as the earnings premium bleeds out.
Where's the big open interest sitting?
Call concentration at the $150 and $155 strikes expiring in May and June suggests traders are positioned for the stock to continue recovering toward its 52-week high of $145.44, which it's essentially at. Put protection is clustered near the $135 and $130 levels, which makes sense as a defined risk hedge floor. The options market is implying a roughly 5% move in either direction for the next earnings report. That's consistent with how industrial REIT stocks typically react. Meaningful but not volatile in the way growth tech reacts.
What are insiders doing?
Over the past 12 months, insider activity has skewed towards selling, with 5 sell transactions recorded against a single purchase. The selling is consistent with stock-based compensation awards being unwound at favorable prices. Not an unusual pattern for executives whose stock has rallied sharply from the 52-week low of $97.
So no panic selling, but also no one stepping up to buy in the open market.
That's the right read. The absence of open market buying is worth noting for investors who like to see insider conviction, but it doesn't necessarily signal pessimism. At this price level, executives who have accumulated shares over years are simply diversifying.
What should investors keep an eye on?
The top risk is occupancy normalization. If industrial vacancy continues rising beyond the current 5 to 6% range and presses toward 8% in key markets, same-store NOI growth guidance could be cut, and that is the central pillar of the bull thesis.
Beyond that?
Interest rates. Prologis is carrying $35 billion in debt. If the Fed surprises with higher for longer, refinancing costs go up and the PFFO multiple the market assigns comes down. It's a double compression that can move the stock significantly even if operations are fine. And watch the development pipeline performance. The company has over $3 billion of active development. If lease-up is slower than targeted or stabilized yields come in below the 6 to 7% guidance, that NAV creation thesis takes a hit. Watch the quarterly development starts and yields in every earnings call.
Let's bring it home. What's the summary?
Prologis is one of the highest quality franchises in real estate, full stop. The business model is simple and durable, the tenant roster is exceptional, and the management team has proven it can operate through cycles. Q1 2026 showed beats on both revenue and earnings, with core FFO tracking to full-year guidance.
The risks are real but manageable. The debt load is the biggest structural concern. The occupancy normalization is a near-term headwind but not a structural break. And the tailwinds, e-commerce, nearshoring, supply constraints in core markets, are multi-year, not ephemeral.
The stock at 145 is not cheap, but you're not paying for cheap. You're paying for the most liquid way to own industrial real estate infrastructure at global scale with a growing dividend and a management team that has navigated multiple cycles.
The one metric to watch, same-store NOI growth. Management said 3.5 to 4.5% for 2026. If they deliver at the high end, this stock works. If occupancy softens and they cut guidance, expect a meaningful pullback. We'll close with a quote from Franklin D. Roosevelt, which happens to be one of the most timeless pieces of wisdom on real estate investing. Real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world.
For a company with 984 million square feet of irreplaceable logistics real estate, that feels pretty apt.
That's going to do it for today's episode of Charged Alpha, the S&P 500 stock encyclopedia. We covered Prologis from the ground up, literally. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.